Welcome back to the third edition of the Small Money Big Dreams blog, the 5-minute finance drill. Once again, I'm your host, Morgan Spanam, and I'm just here to help people and educate people about their finances. So, to recap the last blog on diversification, most people's portfolios are split up amongst two classes of investments, stocks and bonds. And a quick recap: stocks equal ownership into companies. They grant the owners the rights to the assets and earnings of a company if the company was to default. So when you buy ownership equity into a company as stocks, you're basically buying into the value. The stock represents the value of what that company is. And if the company was to have a downturn, stocks give people access to the earnings and assets of a company. Now there's two classes of stocks. There's preferred stocks and common stocks. Now common stocks allows you to have voter rights, and you're technically allowed to attend board meetings and things of that nature. But many people don't exercise that, especially if you have limited amount of shares. Now preferred stock doesn't give you the right to vote and some of the rights of common stock, but preferred stock has a higher claim to the assets and earnings of a company's, has a higher claim on the assets and earnings of a company than the common stockholder. Bondholders, debtors, usually have even a higher claim to these assets and earnings because the bondholders are paid first, then the preferred stockholders, and then the common stockholders. So that's just a brief summary of some of what I spoke about in the last blog. Also, I wanted to also put out there that depending on your age is how you should approach the risk you should take. I always advise older people to be not completely conservative but more conservative, because you have a shorter period to when you will choose to retire. So you want to make investments that grow but are stable at the same time, versus a younger person. You're allowed to take more risks, especially if you're single, have no spouse, B, no children, no dependent, and C, don't have a mortgage. If you're renting, don't have high debt obligations. You can take more risk because as the market fluctuates, if you do lose, you have time to make up for it. But the key to preventing your losses, not preventing your losses, but to protect yourself, the most way possible is to diversify your assets. And I discussed in the last blog, certain ratios you should approach for diversification. This quick little message is to the older people. You might want to think about, on top of diversifying your portfolio, looking into annuities. Annuities, are basically life insurance policies that you pay a certain amount and it guarantees you income over a certain amount of time. Now, annuities are usually offered by insurance companies, and the reason why they offer it, because it's a gamble. They play the game that that you hopefully will not live as long as the obligation, and you play the game that you will live as long as the obligation. So the key with annuities is that you want to find an annuity that takes into certain considerations. You want to find an annuity that don't wish this on anyone. If you do pass earlier than the set contracted time, that your benefits can be passed on to your heirs. Another thing you want to look to in annuities is you want to get an annuity that takes into consideration inflation, because $1 today is worth even less tomorrow. So if you can find an annuity that, one, allows you to transfer your payments that's left on the contract to your heirs, and two, takes into consideration inflation, that is a great annuity. Now, usually if an annuity takes those two, restrictions into play, it will pay you less than another annuity. It might pay you a few $100s less per monthly payment. Now, I know you're thinking, wow, you need the money, but that's part of hedging risk. You might get a lower monthly payment, but it allows you to protect against inflation, and also works as an insurance policy that continues to take care of your loved ones, albeit your spouse, your children, or whoever you consider your heirs. So that's a quick lesson on annuities as another option of investments. That's more towards retirement than investing and building wealth. But annuities is something that I recommend older people to go out and research. I want to further discuss more about bonds. Now, there's a lot of traits about bonds, so many different kinds of bonds, and I'm just going to, try to educate you on certain things about bonds. Now, maturity is when the bond will expire. It's usually a set term. Yield is the interest that you will get from the bond, and there's several different kinds of bonds. There's what's called the callable bond, where the issuer of the bond will be able to, break the contract and recall the debt, and they usually will pay you a penalty for that. Either might pay you, a whole year of interest, even though the bond was called in earlier, or some kind of penalty fee on top of the principal that they owe you for the callable bond. There's another kind of bond called convertible bond, and the convertible bond probably will pay you lower interest, but that bond is able to be converted into shares into that company. Discount bonds. You'll hear the term a discount bond because a bond will be sold at a discount if the interest on that bond being paid is lower than what's the common interest being paid on other investments, other loan type investments. So if interest rates go up, the bond will sell at a discount to make up for the money being lost in interest. Now, on the flip side, there's premium bonds. A premium bond is when interest rates go down and the bond is locked in to pay at a higher interest rate. The bond will sell at a premium, which means it'll cost you more to buy that bond because obviously it's paying higher interest than what's out there. And basically that's a quick update more about bonds. I want to further discuss diversification and describe other investment strategies that you can take, but you know what, my time is coming to an end, and like I said before, I try to keep the blog short and sweet so that you can learn from it, and then you can take it in, come back with questions, and we'll discuss other topics. But that's a brief summary of bonds, annuities, and more lessons towards diversification. Once again, I'm your host, Morgan Spanam, and I thank you for stopping by. Once again, the email is smallmoneybigdreams@gmail.com, as well as the site smallmoneybigdreams.com. I hope I was able to answer some questions and help people out. Like I said before, send me your comments, send me your questions, and we'll try to find the answers. I see you guys on top. Signing off. Good night.